Hey everyone, me Kevin here. Cathie Wood over at Ark Invest, who's gained massive trust for her extremely bullish views on Tesla, just released an incredible market update video. In my video here, I'm going to respond to some of the most salient pieces of what she had to say. So I'll provide a summary of some of the most important things that she said, but I'm also going to provide you some perspective on my thoughts on this, and I'm going to combine some other sources of data, which I think will give us a lot of clarity with what she's talking about. A quick reminder, I have to say this here, you got to get yourself a free $51. Deposit $100 with M1 Finance, you get $30. Deposit $100 with Webull, you get a minimum of $21. You could even potentially get more. So why not? Check that out via the link down below. All right, folks, let's get into this. So first, Cathie Wood is concerned that corporate taxes will go up. So are a lot of us. We definitely expect that, especially now that Democrats have essentially swept. They've got power of the House, power of the Senate, and power of the presidency. And I even put together a video explaining how much power Democrats have and explaining, you can even find that, type into YouTube, Meet Kevin, how much power Democrats have. And you'll see that Democrats have some major opportunities to make some big old change without the help of Republicans. Now, she didn't tell us exactly what kind of impact she expects from higher corporate taxes, but Goldman Sachs via Bloomberg did. Goldman Sachs says, quote, "We raise our 2021 S&P EPS targets, so earnings per share targets, by 2 percentage points to 31%, but an increase in corporate taxes will trim 2022 EPS growth by 2 percentage points to 10%. All right, so let me translate this. Basically, they're thinking in 2021, we're going to have massive earnings growth of like 30%. And that's taking into account Democratic changes here. That's really good. Plus, they think in 2022, we'll have another 10% increase in earnings per share growth. Also, very, very, very good. But they have reduced their targets a little teeny bit because of higher corporate tax rates. I was actually surprised they didn't change their targets substantially more. It seemed like the higher corporate tax rates barely had an impact, according to Goldman Sachs. But anyway, Cathie Wood says she thinks that, she realizes that she was potentially wrong here in the short term. She was expecting a market sell-off after the Democratic sweep. But this is a fair mistake, though. I would say more than 90% expected some sort of serious sell-off after a Democratic sweep. Instead, the market briefly dipped, like futures went like 0.5% lower, but the market pretty much balanced out, and the S&P 500 just kept closing higher and higher and higher. Obviously, over this last week, many positions are much higher than where they were last week. Now, further, Cathie Wood does say, and this kind of reiterates what Goldman Sachs put out. She thinks, quote, "We could see an earnings explosion in this next year." And I kind of agree with her, especially in sort of the recovery sector. We're guaranteed going to see an earnings explosion. How or what kind of profits tech companies and fintechs end up taking? Whew. That could end up being game-changing too. Further, she thinks that the Federal Reserve may end up buckling and changing their strategy. This here is a big deal. She believes, quote, "Once we help the people who need it, the economy doesn't need more stimulus." And that, quote, "Stimulus will lead to higher taxes and be much more wasteful." As a result, she is concerned that the Federal Reserve is going to utilize that money printing, or rather not utilize. She's concerned that the Fed's going to realize that, wait a minute, all of this money printing we're doing or utilizing is unsustainable. And basically, we're going to end up with much higher taxes, which are going to tax away the effect of stimulus. And we should actually stop supporting the money with quantitative easing as much as we are. Maybe stop injecting as much money as we are into the markets, pull back, and maybe we need to step back on our interest rate guidance as well and suggest that maybe rates need to go up sooner than expected. Now, I'm adding this in. She simply said that she thinks the Fed's going to buckle and change course. I'm concluding that Cathie Wood thinks that, we could see a reduction in QE and higher rates. Those are the big things that obviously the Fed could change. Now, Cathie Wood went as far as saying that she thinks people are being too complacent about inflation. She thinks too many people say that inflation is dead, but that people who think this might end up getting blindsided. Now remember this, the Federal Reserve has regularly told us that they do not expect to raise rates until after 2023. And this is me again adding my thoughts here to what Cathie Wood is saying. If the Federal Reserve does not raise rates until after 2023, we still have 21, 22, and 23 at ultra low rates to invest. And this is because the Fed has instituted something known as FATE, Flexible Average Inflation Targeting, where they want inflation to be around 2.5% or maybe even a little bit more for a sustained period of time. So that way inflation averages 2%. So that means if we're at 1.5% for the next year, they would want to be at 2.5% for at least a mirror image year on the other end to average 2% inflation. There are even rumors about raising the 2% target for inflation to 2.5%, which then means to have flexible average inflation targeting, we might have to see 3% inflation for a period of time. So, like, the Fed is a little bit at odds here with Cathie. Cathie's saying, I don't know, we might be seeing inflation way sooner. We might see the Fed end up buckling here and changing course and raising rates sooner. And it's something to be cautious of. Now, while I don't know, obviously, what's going to happen, I appreciate her conservativeness in this aspect. We should be cautious that if inflation comes sooner than expected, the Fed might end up changing course. Now, this right here is going to be a little bit challenging, though, because remember Jerome Powell. Jerome Powell, the dude with the money printer at the Federal Reserve, he's basically told us, and he's been trying to educate the markets, that he believes forward guidance is very important. As in, what he says really matters. He thinks that the more transparent he is with markets, the more likely it is that inflation will actually go where they want it to go and not necessarily dramatically overshoot to the point where they have to change their opinions. Or change their strategies. So in other words, if Jerome Powell at the Federal Reserve changes his mind, he runs the risk of actually scaring markets by appearing inconsistent. So let me rephrase this because it's really, really important. The Federal Reserve says, we want to be very clear with what we're saying. We're not planning on raising rates until after 2023. Cathie Wood is saying, I don't know, the Fed might change their mind. The Fed at the same time is telling us, we want to be very clear with our plan so we properly communicate things to the market. Because the Fed thinks if they properly communicate to the market what's going to happen, then inflation will meet their targets. They think inflation is self-fulfilling. But Cathie's saying, no, the Fed might change their mind. That, if the Fed changes their mind like Cathie thinks, in my opinion, would be really bad for the market. Because not only would the market all of a sudden have to react to, oh my God, like rates might go up sooner. Oh my God, the Fed's not printing money as much as it used to, oh my gosh. But the market would then also react to Jerome Powell being inconsistent with his messaging. And that in itself could be very, very, very bad for the market. We'll talk about what Cathie Wood said about a potential market crash in just a moment, but this alone right here, that kind of shift, if that happens, what Cathie Wood is predicting could happen this year, it would be devastating to the market is my expectation. I would not be shocked to see a 20 to 30% correction in the market. And you know, I think it'll rebound from that, but I mean, certainly it'll rebound from that in the long term. But yeah, I mean, that could be a little shaker to be aware of. If the Fed changes their minds, you got lots of margin outstanding, I want to start considering paying down some margin. All right, anyway. Now keep this in mind as well. Cathie Wood says, while there are serious inflation risks, there is one sort of thing that can offset these real inflation risks, and that is money velocity going down. Now, I'm going to break from Cathie here just for a moment and explain this. We've talked about this before on the channel. We already know that 25% of the money that exists in the world was created in 2020. That's insane. But normal measures of inflation, like CPI and PCE, haven't kept up to expectations. Some say this is fugazi and the measures are wrong. Others say this is because the velocity of money has fallen. That is, people aren't taking money and spending it. They're taking money and putting it into savings, paying down debt, and investing into stocks and real estate. That 2020 was the biggest year for people to basically enter the frugal decade and save, pay off debt, and invest. Now, these choices end up with creating a market that has a much lower velocity of money. And if this continues, then it's possible that inflation won't happen. In fact, take a look at this chart of the velocity of the M2 money supply. It has plummeted, but it even has plummeted for the last 10 years. We've had this plummeting in velocity for the last 10 years. The pandemic hits, plummets. Now, we do have this tiny little, like, almost V-shaped recovery starting here, but we can actually keep track of this to see, is velocity of money going to go back up? If this line starts jumping up again, yeah, we might actually see some inflation coming. And this aligns with what Cathie Wood says. She says that it is possible that if society begins to expect inflation, and this is something the Fed says too, if people expect inflation, inflation will happen. Why? Because if people expect inflation to happen, they're not going to wait to buy that iPhone. They're going to buy it now because they think prices are going to be higher in the future. And thereby you actually pull forward demand and force inflation to happen. If that happens, boom, Fed might have to change course, react quicker. Now they become inconsistent and the market gets slapped upside the head. Pretty bad. Now, Cathie then goes on to slam bonds. She thinks she doesn't find bonds to be a great investment right now. She reiterates there's a downtrend in oil. She believes that EV is the trend to stay with. That's also why Tesla is one of her largest positions. And right now, she believes that if the dollar keeps falling and weakening, that Bitcoin will keep going up. Now, she did say this before the Bitcoin sell-off. She was talking about Bitcoin going up to 40K. Obviously, right now, at the time of this recording, it's on like 30K. It sold off a bit. This is no shame on Cathie here. Cathie is a long-run bull on Bitcoin. She's very excited. She believes that Bitcoin is actually our biggest hedge against inflation. And she's really excited about blockchains getting the green light to be used as a method of settlement via the OCC. Basically, the OCC is the Office of the Controller of Currency. They basically tell banks how they can settle transactions. And they're giving banks the green light to use blockchain. She thinks this gives not only huge validation to Bitcoin, but also helps reduce banking costs and will eventually promote stable coins. So in other words, all that condensed, Bitcoin to the moon, basically, okay? She then compared Bitcoin to Tesla, saying that Bitcoin has a market cap of around 700 bill, Tesla has a market cap of around 800 bill, and that they're both big ideas. Remember, Tesla is her biggest holding. She just made a perfect parallel, near perfect parallel to Bitcoin. In other words, she thinks the future for Tesla and Bitcoin are really good. Then she believes that we're going to have a great period of investing ahead. She does warn, though, that there could be some significant downsides and a significant correction this year. In fact, she says, I'm sure we'll go through a doozy of corrections, multiple, plural here, this year at some point. Never hurts to take some profits now and then pick up on bargain basement prices in the future. That's a pretty big statement. And I mean, based on, the correlations we were able to make here between the Fed and what Cathie Wood is saying, she's right. We might see that market crash, especially if the Fed changes their mind. If velocity goes up, pay attention to that chart. I'll link it down below. If velocity goes up, danger. If the Fed changes their mind, huge dangers. And those could reiterate that correction that Cathie expects. So bottom lines and takeaways here. Be prepared. Don't be too way extended on margin. Be prepared to have some margin available so you can go shopping when and if the market falls and you don't get margin called. Now, Goldman Sachs and Cathie expect earnings to explode this year. I agree. However, keep in mind, even though we're expecting, earnings to explode, personally, I'm going on a little bit of a stock diet for a bit. What I mean by that is I'm going to work to pay down as much margin as I can over the next 2 to 3 months so that in the event there's a larger drop, I'll be able to join into those bargain prices. And that I really like, especially with how Tesla and like Lemonade, for example, and even Purple, a company I recommended at $18 and I got made fun of for basically being a shill for pumping the stock, it's up another 9% today. It's insane. It's over doubled now from my recommendation. Lemonade's a 3-banger now. It's insane. But anyway, to me, this is a sign that I need to hold back a tiny little bit and start paying off some margin and just be prepared. On inflation, I think the key here is paying attention to that money supply, that money velocity, or the velocity of the money supply chart. Pay attention to that chart. I will link it down below. Additionally, if Bitcoin keeps selling off, we could see some nice opportunities to actually start trying to invest in Bitcoin seriously. I've got a very small exposure to Bitcoin, and if it gets to some more, let's say, low prices, I'd be more interested in actually having a reasonable portfolio or portion of my portfolio in Bitcoin. But we'll stay tuned for that. We'll see how much Bitcoin sells off. So there you have it. In the meantime, thank you so much for watching. If you found this breakdown helpful, consider subscribing and sharing this video. My goal is always to be additive. I don't want to just like reiterate only what Cathie said. So hopefully you found that this was a lot of additive information to what she said. I will link her video down below. Thanks so much for watching, and folks, we'll see you in the next video.